Hey guys, welcome back to the Saturday video, and today I'm doing something kind of old school, kind of an ETF review. Someone actually mentioned that in the comment last week that they missed my ETF reviews, and honestly, I haven't done them because I haven't found anything really interesting that really interested me until today. That comment sparked my look into what's new. And here we are. I've found iShares 20-year Treasury bond BuyWrite strategy ETF. It's essentially a covered call ETF on U.S. Treasuries, fixed income. Now, iShares put out about 3 of these new ones, all BuyWrites, and I'm not going to go over all of them, but I'll go over probably what's going to be the most popular, and that is TLTW by iShares. It's the Tilt iShares 20-year Treasury bond BuyWrite strategy ETF. So if you're new here, please like, share, subscribe, do all that good stuff. Down in the description below is ways you can connect with me. There's a Linktree link with all kinds of stuff in there. Also my Amazon link that a lot of you have been using, and I truly appreciate that because it throws a few pennies my way and makes this a little less painful. So what do we got? Today we got Tilt W, or TLTW, and it's basically it's iShares Treasury bond ETF with a covered call strategy on top. Okay, you'll see here on the screen has an expense ratio of 0.5%, half a percent. But the net is 0.35, so they have a expense waiver of 0.15%. I don't know how long that lasts, but 0.35 is not too shabby. We'll take a look at their general information here. And iShares, it's seeking higher income. And I want to make some points on this because some of the language is a little bit... I don't want to call it misleading, but I can see how some people might take it a little odd. Okay, so the point of these ETFs, it's a BuyWrite fund, may provide enhanced income by selling monthly covered call options. Now we all know about, QYLD, RYLD, XYLD, all that, those plain vanilla covered call funds. Okay. BuyWrite funds may outperform in periods of rising rates and widening credit spreads. Now, this is part of what I don't like about some of the language is BuyWrite funds may outperform in periods of rising rates. Outperform what? See, that's what you got to think. What's it going to outperform? Well, it's going to outperform TLT. So even though it's, even if the fund were to drop, what they're saying is it's going to drop less than the TLT because of the inherent income that you're receiving from the covered calls. There's not anything, it's not going to outperform to the upside. Like if Tilt drops 10%, this isn't going to rise, right? It may drop 5%, but you're still going to fall. Okay. I hope that makes sense. Let's see what else. So here's the 3. So it has the iShares 20-year, and here's some important things that I think and why I think TLTW is going to be the most popular. So the underlying ETF is TLT, the strike price, which is where they're going to sell the covered call. They're going to do it at 102% of the closing value. Okay. So let's say Tilt is $100. Okay. They'll write a 1-month covered call at $102. So you will get the premium that they were able to generate from selling the call option. Plus you have the potential to participate in the 2% upside of TLT. Okay. They also have the investment grade corporate bond one. The underlying ETF is LQD, but here's the kicker. The strike price is going to be at the money. They also have a high yield corporate BuyWrite. And again, the strike is going to be at the money. So what that means is it will generate more income, but you will not participate in the upside if there is upside like you would with TLTW, because they're, if the tilt is 100 and you sell a covered call at 102, you get that upside from 100 to 102. Now, if liquid or HYG is 100 and they sell it at 100, you get no upside. You just get the income. Okay. This was a very interesting one here. Ones that I want to kind of point out. So this is a monthly ETF, and BuyWrite strategies sacrifice potential return of the underlying bond ETF in exchange for monthly income. And that is more so, especially in the corporate bond ones, not in the TLTW. Okay. So when rates rise and spreads widen, the underlying bond ETF depreciates. Okay. So that's how the yield is tied to the price. So if rates rise, the price has to fall to meet that yield, meet that rate. Okay. BuyWrite strategies versus underlying ETF potentially outperforms. Now there you go. But versus the underlying ETF. See, a lot of people will see this and just say, oh, it's going to outperform. It's just going to outperform the underlying ETF. Okay. It doesn't mean that it's going to go up more or drop as much. It's not going to drop as much, I guess, is what the real thing is. And there you go. Premium income offsets losses. Rates and spreads are stable. The underlying bond ETF remains unchanged. And the BuyWrite strategy potentially outperforms because you are getting the covered call income. And then the rates fall, spreads tighten. So the underlying ETF appreciates. So when they start talking about cutting rates, the value of TLT is going to rise. So the BuyWrite strategy versus underlying ETF potentially underperforms. Why? Because you are only participating in whatever the difference between what you bought it for and the strike price. So that's why I said if rates fall, you're going to want to be in probably TLTW, because at least you'll get the premium income plus the 2% in capital appreciation. Whereas the other ones that sell at the money, the corporate bond ones, you will not participate in any upside. So I hope that makes sense. So the summary prospectus, I think I just went over it pretty much pretty well. I don't know if there's anything I can add here. Portfolio turnover might be an issue, right? So instead of just buying and holding TLT, there could be some short-term cap gains in this covered call in the premiums because they're just going to buy and sell the options. They're actually not going to trade in shares. They're just going to trade in options. It's cash settled. So they're European style call options. So it's going to be settled in cash, basically. So shares are never going to change hands. Okay. Real quick, I wanted to talk about TLT and the distribution rate. There's no official distribution rate. Okay. But what they have here for their first distribution is 55 cents. That seems a little stretched to me. Okay. Because if we look at, let's say 55 cents divided by the share price today, which is Friday, September 2nd, we get 1.4% in a month times that by 12, you get 17.25%. That seems a little, that seems a little much. It seems a lot much, but let's take a look, because Tilt has a 2% yield as it is yearly. So you're talking about another, what did I say? Another 15% on top of that with options. Let's take a look real quick at how we can do this. Let's look at the options chain for TLT. And we're at 110, so let's call it, what is 110 times 2%? 110 times 2% equals 220. So they need to be at 112 roughly for the strike price and out 30 days. So let's go out 35 days. So we need to be at 112. So if we look here, we'll click on that. And we'll see you'll get about $2, okay, for the 112 strike. So it was at 110, so $2 for the 110 strike divided by 110 would be, gosh, math is messing me up right now, $11,000. So $2 divided by $11,000 equals, man, that's a 1.8% yield. So pretty darn good if you ask me. I'm a fan, and if we look at TLT and the chart, you'll see the rate, when rates increase, you'll see that activity within the underlying ETF. So you'll see when rates were near, nothing, TLT was at $150 a share. Now that rates have risen, the share price has to follow that yield. So now we're at 109. So let's take a look at a long-term chart here. We go 5 years, and you'll see there periods of zero interest rates and then rising interest rates. So TLTW, I like it, but if you have the time to do it on your own, you can probably do better. Because like I said, you got $2 of a option premium versus the $11,000 investment. You get 1.8% a month, basically, times that by 12, 21%. If you had the time to do it yourself and you have the money to buy the TLT, you would probably be better off doing it on your own if you're comfortable with doing covered calls. If not, I think buying TLTW is not a bad deal. Especially at this point where the rates are high. I don't know, eventually rates, they're going to have to pull back and cut rates. And this is going to make the TLT and the TLTW rise in value. So will I open a position? I don't know. I doubt it, because I don't like fixed income products, but it's very intriguing. So hope you guys enjoyed. Let me know your thoughts down below if you're going to take a position in this. I'm going to consider it. I'm definitely going to consider it. But we'll see. Hope you guys enjoyed. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.